SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI Bocconi Meet the Authors webinar on fiscal policy in a turbulent era. Fiscal policy has regained importance over the last 2 decades, playing key roles in fighting the global financial crisis and its economic fallout, the COVID pandemic, and the repercussions from global conflict. At the same time, these far-reaching interventions have resulted in ballooning sovereign debt ratios, triggering the European sovereign debt crisis and prompting some renewed concern by some commentators more recently on debt sustainability in the post-low-for-long world of higher inflation and higher nominal and potentially also real interest rates. Now, what are the most important trends for fiscal policies in the 21st century? How can fiscal policy be made more effective and targeted by learning from recent experiences? How can fiscal resources be freed or mobilized to enable important investments such as climate protection and the transformation of our energy systems, innovation and technological progress, aging and migration, and, if we want to run out, defense? How should fiscal policies deal with high uncertainty regarding future scenarios? This SUERF BAFFI Bocconi Meet the Author webinar marks the publication of a new book on fiscal policy in a turbulent era, Tectonic Shifts. A warm welcome to the editor and mastermind of this book, Enrique Alberola, advisor at the Banco de España. Enrique's presentation will be followed with comments by selected authors of various book chapters. Let me give a warm welcome to Vitor Gaspar, Director of the Fiscal Affairs Department at the IMF and an old-time colleague and friend of SUERF, and Hugo Panizza, Professor of Economics at Geneva Graduate Institute. Now, without further ado, over to you, Enrique, for an introduction and overview of the book.
Thank you, Ernest, and thank you, my colleagues and contributors to the book, for being able to be here today. It's a great pleasure and honor. The book is called Fiscal Policy in a Turbulent Era, Tectonic Shifts, and in the first chapter, what I did is to join the dots of the different chapters by the different contributors to have 20 takeaways from the book. And this is what I'm going to go through them to give a coherent picture of how we see fiscal policy in a turbulent era. The book is actually an offer, a request, a proposal by the publisher, Alberola, which I was a bit reluctant to accept at the beginning because, you know, it's a very big area. But when they told me that the name of the series was In a Turbulent Era, I joined the idea of fiscal policy in a turbulent era, and I realized that there were really big changes. And structuring these changes and looking for authors was the reason why I said yes, and the contributors duly accepted, and that's the result, this book. So the bottom line of the book is that the global fiscal financial crisis and then the pandemic have transformed fiscal policy and also its perception from the previous period, which you may remember, it was Goldilocks economy, everything was right, and fiscal policy was at the sidelines. This has been, in my view, a tectonic shift of great proportion, call it paradigm shift or not. But, and I think that's the interesting thing of doing this session today, the question is whether the pendulum is shifting again. This out of sample shifting, not when we were on the book, but now there's been a shift for the reasons I will mention. So the book is basically a pause for thought, structured in 3 parts. The first is, which are these changes? The second, which are the concerns and challenges going forward? And which are the implications for fiscal policy now? We are also already experiencing them and looking ahead. And I will structure my comments and the takeaways around these 3 blocks. This is the structure of the book. I will not go through it. for the sake of time. And these are the first 9 takeaways which describe the current status of fiscal policy, or the status, let's say, when the book was finished. Now we are moving, as I said, independent. The first and the main one is that fiscal policy has gained relevance in multiple dimensions in this turbulent era. As I mentioned in the book, the fiscal mood has definitely changed from before 2007 to nowadays. Now the mood is much more positive regarding fiscal policy. I would say also much more expansionary than in the past. And this is what the book uncovers through the different chapters. And this is the second point. This is in spite of historically high public debt, which is a bit of a puzzle, because public debt limits the space of fiscal policy in theory, and this should lead to a constraint of fiscal policy or activism in fiscal policy. What explains this puzzle? What explains this puzzle is the low level of interest rates that we have enjoyed during this turbulent era. When I mean interest rates, I refer to real long-term rates, natural structural interest rates. These structural interest rates are determined by structural factors and not by monetary policy or short-term actions. This is very important for what I will say afterwards, because we are now seeing something, interest rates going up. So we have to look through this period. In any case, low interest rates have gone down because of structural factors. Low interest rate, natural interest rates are determined by the crossing between savings and investments. So all the factors that determine this, saving and investment, move interest rates in structural terms. Aging implies a decrease in real interest rate long term, and this is a big factor into the reaction. But also is the higher inequality, because high income people tend to save more. Low income people, yes, tend to save more, so this brings down interest rates. And all other factors like the demand for safe assets that we had in the turbulent era, related in partially through uncertainty. And this, what is important, has more than offset a factor that should have increased interest rates, which is actually the increase in debt. So this offsetting effect has been massive and has allowed a graph. I just want to show you 2 graphs. The first is one. This is the estimation of real interest rates in 3 big economies, and you see the difference between the 80s and 22, which is the end of the sample. Vitor will talk you probably about the change in this graph, the change of trend. That's a question mark, but this is the fact. Other element moving down interest rate is that we are in a period of low growth, and this also brings down interest rate because it leads to less investment opportunities. This is a very, very, very striking graph, which explains the puzzle. Here we compare public debt in the 3 main economies with the effective interest rate, which is the actual cost of debt. And this, you can see an almost perfect negative correlation, where you should see a positive correlation. Why? Because the increase in debt has coincided with a big fall in the real natural rate, and the public debt impact has been offset. So this is key in the explanation of the change in fiscal policy. And on top of this, we have another big change in monetary policy. Very low inflation, 0 interest rates. These facts have empowered fiscal policy, because with low interest rates, fiscal policy is more effective. Why? Because a fiscal expansion does not push up interest rates, because then it does not generate inflationary pressures. This means that discretionary fiscal policy has become more effective. It is also true that in recession or big crisis, fiscal policy can be more effective. But, and I think this is very interesting, there has been also a paradigm shift in academia. Before this turbulent era, the multiplier estimated were close to zero. And this supported the idea that fiscal policy should be passive. Now, with the recession, with the low interest monetary policy, the new estimates on multipliers are putting them in a much higher level, implying that it's more effective. And of course, this again supports the idea that activism in fiscal policy pays off. Other element, the sixth, is that automatic stabilizers have weakened. And one important determinant of this is that we have much less progressivity than in the past, both in unemployment benefits, but also in income tax rates. And this is a nice contribution in the paper. I cannot stop here. Other element of this era, we enter with this mantra of fiscal rules, no discretion on fiscal policy. Many countries in the beginning of the century started to impose, to adopt fiscal rules, and they have been disappointed. And another paper evaluates that. So the promises have not been fulfilled. Why? Because the quality is the key. When you control for quality, they have been effective. The problem is that not many have had good quality. The other element, and this is the other big thing, is the ever-increasing demands on fiscal expenditure within this period. And this is due to structural changes. The main one is aging, more expenditure in pensions, in healthcare, and what is coming in advanced economies, care, which is still small, but this may become much bigger because of the political equilibrium regarding age. We are becoming older and more worried about our future, and we will demand care. So this generates another big tension in fiscal policy. The last point I want to highlight is that fiscal policies have gained regional and global scope for two main reasons. One is climate concern, which is a global phenomenon. Every country has to contribute. And the second, more psychological, the pandemic showed how weak, how alone we are in the world, and we are a global community. This may be psychological, but the fact is that regional and global efforts to react fiscally have improved. For instance, globally, you have the agreement of corporate taxation sponsored by the OECD and the G20, of course. And at the regional level, you have the European Next Generation Program. So this is the status quo. What are the prospects and risks of fiscal policy? Well, the prospect, but we are there already, is that fiscal policy is going to lose effectiveness in the evolving economic environment. The main reason is inflation. The other reason is that the fiscal push has been so big that probably the effectiveness is, you have target everything, is too much to grapple with that. The other important thing is that we are seeing an increase in interest rate. Also, the estimates of the natural rate, that figure I put you before, it's picking up, as Vitor will show. But the important thing is that the structural factors have not changed much. We are not going to grow more, aging is going on, inequality is there, so they will probably remain low in the long run, which give us some relief for the future regarding the space of fiscal policy. In any case, public finances are overstretched. So, in any case, the scope for increasing fiscal revenues is very, very much limited, in particular in advanced economies. In emerging, you may have a lot of things to do in terms of efficiency, increasing the basis, but in advanced economies, we are over the top, probably. Well, over the top now, but, on the limit. Another element, which I think I joined the dots here, I want to underline it, is rules. I mean, these periods have experienced a big discretion in fiscal policy. This means that you have to go through the parliamentary processes, and this makes fiscal policy less efficient and more politically biased, in particular in a world of polarization. So, if you have less automatic stabilizers, more discretion, you risk to have a less efficient overall fiscal policy. The other element, the big one, the elephant in the room, is that debt is at very dangerous levels. And the miracle, almost, is that nothing has happened in spite of these very high levels of debt. I think this is an issue for discussion. Why it has not happened? In any case, debt service is going up because low interest debt is maturing, and the new debt has 2, 3, 4 more points in terms of interest rate in yield. And we saw last year the higher defaults, last 2 years, the higher defaults in the last decades, sovereign defaults. This means that all this means that the fiscal policy is set to shrink, perhaps abruptly, and this is where the credit risk elephant in the room may come up. This has not happened in advanced economies since the fiscal crisis in Europe, even if debt is higher now. So the priority is to preserve it. How? Well, obviously, what we have to say, and Vitor is here repeating this, also the European Commission is, and the Banco de España, of course, a genuine commitment to medium-term consolidation. But I think, styling from the book, for the chapters, this has to become with a reassessment of the government role and optimal size, in particular with a view in all these increasing demands, and I think Vitor will comment also on this. So it's necessary to improve the quality of fiscal policy, and something which strikes me is that with all the technology we have, all the data we have, we don't use it enough to target better fiscal policy. Fiscal rules are coming, they have been reactivated, and that's good, and improves in the design have been taken up, which is also good. However, in particular in Europe, this should be complemented with a central fiscal capacity for the next generation. And what is surprising, maybe not so much, is that the new fiscal rules have not mentioned a word on this central fiscal capacity that exists, but may not exist in the future. This is an open question. To finish, the overall challenge is to reconcile the central role of fiscal policy with sustainable debt. And this is all. I just wanted to tell you that let me show you if I can. You can access oh no, it does not work. So you can find this chapter that I have explained to you on the website of Elgar, and that's at your disposal. Thank you very much.
Thank you very much, Enrique, for this excellent introduction. So obviously you cover a lot of ground in this book and touch upon really crucial issues. What I find particularly useful and important is your forward-looking perspective. You also emphasize the opportunities, the challenges, and importantly also the limitations and the necessary change. Let's now zoom in on some more specific questions. Let me start with Vitor or Gaspar. Vitor, how do you see fiscal sustainability in conjunction with the level of inflation, interest rates, and growth? And how far might the US and Europe differ in terms of fiscal policy, fiscal sustainability, the fiscal outlook? Vitor, over to you.
Thanks, Ernst, and I'm very grateful to you for hosting this book presentation and having us. And I'm also very grateful to Kike for his leadership in the project. I will be answering your question by looking at my chapter in the book that emphasizes, among other topics, debt and interest rates, and using the recently issued fiscal monitor that came out in the spring of 2024 to make the bridge to the conduct of fiscal policies right now and the various aspects that you referred. I believe that Misa is going to share the slides, but quite apart from that, I want to start with US debt and interest rates from a very long run perspective, which is the first slide of this presentation. We go back in this slide to the late 18th century, but I want you to focus, if you would, in the last 45 years or so. So you actually see that from the early 1980s onwards, debt in the United States in purple has been increasing steadily, and it has now reached very high levels. You have the debt scale on the left-hand side. But at the same time, and interestingly, you see that nominal interest rates have fallen quite sharply. Now, if you now bear with me and focus on the period that starts in the early 1990s, you see that the decline in nominal interest rates was so pronounced that the interest payments on budget as a percentage of GDP fell until the early 2000s. And then they continued at a relatively low level as a percentage of GDP, despite a sharp rise in the public debt level. So low interest rates compensated the servicing costs associated with a high debt level. But that has, in a sense, shifted sharply in the last couple of years, with interest payments on budget and interest rates in the US going sharply up. One point that I emphasize in the chapter, and I want to emphasize now, is that shows the importance of looking at interest rates as endogenous variables. Next slide, please. Now, one point that Kike emphasized, but I want to emphasize again, is that for a very long period of time, and on the left-hand side, we have like the last 20 years, interest rates were actually at the lower bound. So monetary policy was constrained by the lower bound on interest rates. But in recent times, in 2022, most advanced economies have exited the effective lower bound, and even Japan more recently has done so. And you can see on the right-hand side that there was quite a roller coaster in inflation, and this sharp increase in inflation obviously triggered a monetary policy response that was actually quite effective at anchoring inflation and inflation expectations, although the job is not done yet. Next slide, please. I think that this slide is quite important because it shows how volatile interest rates are compared with growth rates. So you see that the continuous line that is very, very jagged is the 10-year bond yield. You see medium-term growth projections as the step function, and you see that the fluctuation in bond yields is substantially bigger than the real growth projections. So the endogeneity of interest rates is something that one has to think carefully about. Next slide, please. And that's precisely one of the aspects that we emphasize in the book. and I have a more detailed analysis in a paper co-authored with Cao and Peralta, which is listed in the slide as forthcoming, but is actually available already as an IMF working paper. And so what you do see is that even in a situation where R minus G is negative, there is a limit to the maximum primary deficit that can be financed. And once you reach that peak, the primary deficit that you can sustain actually goes down. And once you get to a sufficiently high level of debt, the equilibrium R minus G is actually positive, and the type of dynamics that we get from old traditional macroeconomic policy textbooks applies again. But the crucial thing is that once you consider, as we do in this model, that both growth rates and interest rates are jointly endogenous, there is always a fiscal limit, right? There is no possibility to sustain unbounded levels of debt, which is something that we as economists should have suspected anyway. Next slide, please. The situation these days is very demanding because real growth has been trending down for the world as a whole, for the US, quite substantially for China, and our prospects for debt 5 years ahead is that debt will continue to increase. Next slide, please. Now, you asked, Ernst, about the difference between the euro area and US, and that's actually quite remarkable. If you concentrate on the period up to 2022, qualitatively, the response in the euro area and US to the pandemic was similar. By coincidence, in 2022, the cyclically adjusted primary deficit was about the same at 1.9% of GDP. But while the cyclical adjusted primary deficit came down in the euro area, it went quite substantially higher in the US, and it stays quite above the euro area over the medium term. The euro area in this measure approaches balances. Now, that explains the divergence in debt levels on the right-hand side. For the US, the debt level is now higher and projected to grow faster than pre-pandemic. In the euro area, the public debt level is also higher and projected to decline slower than pre-pandemic, but the divergence between the two economic areas is quite visible. Next slide, please. So this is the overview slide. This is my last slide, and it depicts a policy trilemma that we believe is very relevant for countries around the world. So we have spending pressures. The Fiscal Monitor documents that the political discourse speaks about fiscal expansion predominantly, and in the political discourse, there are many calls for fiscal support. So there is a pressure towards increased spending. Taxation has never been popular, but the degree of political red lines on taxation seems to be particularly strong right now in this election year. We have documented in the fall that there is quite a lot of reluctance to using tax instruments to internalize external effects associated with climate change, for example. But if you have high debts and deficits to start with, and you have spending pressures and you cannot increase taxes, the risk is that debt and deficits will continue elevated, debt will continue to grow, debt sustainability will be under threat, and financial stability endangered. So these three elements that look difficult to reconcile constitute a policy trilemma, which is one of the way to think about the challenges that Kike covered in his introduction. I have some estimates of magnitudes on the right-hand side, but for the sake of time and my credibility to finish inside the 12 minutes allotted, I stop right now, Ernest.
Thank you very much, Vitor. I think it becomes obvious from your analysis that going forward, fiscal space and fiscal sustainability will crucially depend on economic growth and thus notably also on technological progress, where Europe is actually not doing so well, and the containment of global conflict as well, and B, on the level of interest rates, which are in turn ultimately dependent on the outlook for inflation, global demand, but also the prevalence of adverse supply shocks. Thanks also for pointing out that also today, despite all changes in paradigms or whatever, there are limits to fiscal debt sustainability and to the to sustainable debt levels. Now let's now turn to Ugo. What is the fiscal situation and outlook in emerging market economies and in low-income countries? Where are we finding ourselves between successful debt reductions and the risk of debt explosion, as you call it? What are key underlying drivers?
Thank you. Let me just join Vitor in thanking you, Ernest, for organizing this, and Kike for the book. So let me starting with an analogy which has nothing to do with economics, but maybe it's in the head of people in Spain, Italy, and Austria. And it's the motorcycle racing. So if you look at motorcycle racing, you'll notice that the best three pilots, best three riders, two are Spaniards and one is Italian, and the three best motorcycles, two are Italian and one is Austrian. So I guess so that's a link. And if you think about motorcycle racing, but if you like Formula One racing, whatever, it's the same thing. You know, to do well, you need two things. You need a good rider and you need a good motorcycle. One is not enough, right? And so this will be a little bit of my message, that if you have a good outcome in fiscal policy, but I guess in almost everything in terms of that, you need a good fiscal policy. So this is like, I will think of this as the motorcycle rider, the quality. So you need Marc Marquez or Jorge Martin or Pecco Bagnaia. And then you also need a good motorcycle. So let me just, and I will continue this analogy a little bit. So what we did in this chapter, we looked, so we didn't want to look at year-over-year changes in debt. So we looked at periods of 5 years. So we picked all countries for which we could have data on that. So we got about 156 emerging and developing economies. For most of them, we could get data going back to the 1980s, and we look at what happened in the typical 5-year period. And if you look at this graph, you see that, you know, when we think about optimal fiscal policy, we think that, you know, you should run deficit in bad times and surpluses in good time, and you know, and then the debt more or less goes up and down. But this clearly showed that that's not the case. Debt on average has been going up, and it's a little bit reflected in various graphs that we have seen. On average, when we look at all possible 5-year periods, that has been going up by about 2% over a 5-year period. And of course, there is a big heterogeneity across regions. So as you might think, things are pretty good in East Asia and Pacific, where actually debt on average has been going down. They're not so good in Latin America and the Caribbean, or in South Asia or in Sub-Saharan Africa, Eastern Europe and Central Asia. Here we don't have data going to the 1980s because for these countries, data start much more recently, but that has not gone up much, and the Middle East somewhere in between. So that's just a picture. Here, I want to go a little bit into the motorcyclist and motorcycle analogy. So when we, so if we decompose the drivers of what makes that go up, we see that there are various elements. So this is when we study this, when we study, fiscal policy 101. So that changes if countries run a primary deficit, that is, they spend more in non-interest expenditure than what they get in taxes. And then it also goes up if they spend a lot in interest. So this is the dark blue thing. And then it also goes up if they spend a lot in interest rate. This is the orange thing. And it goes down, it's a debt to GDP ratio. So if the denominator goes up and the denominator is nominal GDP, which is given by prices and real economic growth, and so that GDP ratio tends to go down with inflation and with real economic growth. And then there is a last thing, which is, I wrote a paper a long time ago, I called it the unexplained part of debt, which is the stock flow reconciliation. So let's think about fiscal policy as the motorcycle rider, the primary deficit. And here you see that for many countries, this is the blue part in the graph. For some countries, very important, for South Asia, for Sub-Saharan Africa, for Eastern Europe and Central Asia. But for many countries, it's not such a large driver. So by the way, here, whatever is above zero, it's something that pushes towards a higher debt to GDP ratio. And whatever is below zero are things that push for a lower debt to GDP ratio. Now, when you look at this graph, you see that actually one of the biggest driver of the decreases in debt to GDP ratio, it's inflation and growth to some extent. And the biggest driver of increases to debt to GDP ratio are this unexplained part of debt and interest payment. So, but I don't wanna get Vitor upset. I will say something later about how these things tie together. So, but that's just if you look at the data. So this was this old paper that I wrote 20 years ago, and the results more or less still hold. Let me just skip this. So what did we do among other things in this paper? We looked at, as Ernest said, at debt explosions and debt reduction. So we looked at extreme events in both cases. So for instance, this is a distribution of all the possible realization of this change in the debt to GDP ratio over 5 years. So you see, we have some countries in which the debt increases by 100% in GDP over 5 years. It's a really kind of an extreme thing. And you also have countries in which debt went down by 80% of GDP. So we looked at the whole distribution of all these episodes. There are hundreds of them. And we define as extreme debt reductions cases when are in the first 10 percentile of the distribution. So these are countries in which debt went down really a lot over a 5-year period. And then we also looked at the 20th percentile. And then, so these are our debt reduction episodes. And then we look at cases in which debt went up a lot. So these are cases in the top 19th percentile. So these are our debt explosions. So we classified countries into this group. 10p debt reduction, so large debt reduction, 20p debt reduction, these are debt reduction which are still large but not as large, and then huge debt explosion, these are the 90, and kind of large debt explosion but not huge, these are the 80. So if we look at all these episodes, we see that we have a lot of debt reductions in Sub-Saharan Africa. That might seem surprising. I'll tell you more why. And less debt reduction in East Asia. But there is a symmetry with the debt explosions. We always have a lot of debt explosions in Sub-Saharan Africa and less debt explosion in East Asia. So you might start thinking that, well, why do I have so many debt reductions? Because debt went up a lot and then I have to do something about it. And how we do this, it's important, and I'll get that in a moment. So now we have classified countries into debt reductions and debt explosions. If you remember before, what drives growth, what drives the debt to GDP ratio? It could be good fiscal policy. It could be that is a primary surplus. It could be the behavior of the interest rate. It could be the behavior of economic growth. It could be the behavior of inflation, or it could be the stock flow reconciliation. So if I split my sample and I look how many of the debt reductions are driven by one of these factors, how many are driven by good fiscal policy, how many are driven by high growth, how many are driven by inflation, how many are driven by very low real interest rates. So in this case, real interest rates which are negative, which is not a great thing because a negative real interest rate is a signal there is some problem. And how many are driven by the stock flow reconciliation? Well, I find that in reducing that, inflation plays a role. And again, that's not a great thing, right? You know, usually when you reduce debt by inflation, it's usually because you have very high inflation. So that's not a great thing. The best debt reduction you want to have are growth driven, and that's good. So growth is the second main driver. And then primary balance driven. The primary balance, it's important. So good fiscal policy explains about 1/3 of growth reduction. So it's important. What is a little bit more disconcerting is what happens if I look at what drives, I don't know if it's disconcerting, but I mean, I don't know how you want to take it. What happens when you look at what drives debt explosions? And here, it's a little bit a reflection of the graph that I showed you before. So there are two main factors driving debt explosions. One is the stock flow reconciliation, and the other one is bad fiscal policy. So again, if you want to go back to the analogy, so these are bad, people who are not doing well in our motorcycles, in our MotoGP, and they are not doing well for two reasons. One, the rider is not very good. We're having high fiscal deficits, and might be the motorcycle, the economic structure, what is this person is driving has some problem. It's the stock flow reconciliation. If we split this among regions, we see that, here, the color of change, we see that the stock flow reconciliation is important pretty much in every region in the world. So what drives this stock? What drives this big thing, this like bad motorcycle, if we want to keep our analogy? Well, there are two things. One is actually fiscal policy with another name. It's fiscal policy with bad and untransparent budgeting. So these are deficits which are not recorded, and then at some point they show up. The other thing are all sorts of contingent liabilities associated to state-owned enterprises, public banks, and whatnot. And the third thing are issues related to debt structure. So when you saw some countries which the debt to GDP ratio went up by 100 points in 5 years, this was, this happened in Argentina, for instance, in 2001, 2002, when the most debt was denominated in dollars. The Argentinian peso, which was pegged to the US dollar, depreciated, and the debt ratio went up. So part of it is due to balance sheet effect. So again, so if you want to have good outcomes in terms of debt, and you don't want to have these debt explosions, you need to have good fiscal policy, and you need to have debt structures that prevent this debt explosion, and an economic structure that prevents all these hidden liability, which at some point show up. Now, this graph, I hope that Vitor will agree with me on this. This graph, this figure underplays the importance of good fiscal policy, because if you go back to the motorcycle analogy, the good drivers get the good motorcycles. So if I go to Ducati and say, hey, give me a Ducati to ride it, I'm not going to get it, right? So Marc Marquez get the Ducati, I don't get it. So in a sense, it is by conducting a good fiscal policy is that you create a situation in which you don't have all these contingent liabilities, in which you can afford having a debt structure which will not lead to these sudden debt explosions, which then will cause disaster on the debt side. So just to conclude, the IMF stance, it's mostly fiscal. Debt explosions are not always fiscal, but even the ones that are not fiscal might have at the end some fiscal root. I'll close here.
Thank you very much, Ugo. So I take along that the picture is quite diverse in emerging markets. Relating back to Vitor, it is obvious that global institutions like the IMF and the World Bank have an important role to play going forward in terms of advice, in terms of analysis, in terms of eventual help. So I suggest that we continue by commenting on each other's presentation so far, and then we enter into a Q&A round. So maybe if Enrique could start commenting on Ugo's and Vitor's points.
I would like to start by maybe emphasizing one point that Vitor has made, that on the endogeneity, but in the chapter he develops that, and I guess also in the fiscal monitor, and I think that's very important, no? Is this spiraling down of interest rates, debt, interest rate, and growth. The higher debt, and this is a point you make very well, the higher debt means that there is a stock of debt to refinance. This reduces the funds available for other uses, in particular investment to push growth. And I think that's a very important point, even if it's not reflected immediately on rates, as we have seen in the turbulent era. This is pushing down growth, and by that it is pushing up debt, or make more worsening debt prospects. That's one point. The other point is on the chapter that Ugo and Andy provided, and he has mentioned, give you the main principles, is on inflation. Inflation as a temptation to reduce debt. As a matter of fact, we have seen now in this period that on impact, inflation has helped to tame the debt increase after the pandemic. But of course, this is not a long-run solution. This leads me to a point I did not delve much on, but of course, as a central banker, or having worked in central banking organizations, is very much on top of my mind, which is the role of monetary policy. I mean, the big thing, apart from zero interest rates during the last part of the turbulent era, has been the asset purchases and the increase in the central bank balance sheets. And there, what we have now is, and maybe unexpectedly, a reduction on the central bank balance sheets. And I wanted to mention something, actually also questions or issues for discussion on this. First, and I have a paper on this, on the possible impact of the reduction of the debt rates through the credit risk on debt sustainability. It said the paper it was manageable, but as a matter of fact, what is happening is even less impact, actually no impact at all on credit risk. in particular in Europe, which is where the credit risk issue came to the fore in the last decade. Maybe the reason here, well, one could say that you know, the ECB, the Euro system, has made it very nicely. This TPI, this preventive arm to avoid this, to give some leeway to further purchases if things go wrong. Maybe this has had the right signaling effect. Maybe, we don't know. The fact has been that. The other is maybe more concerning going forward. Well, in the overall setup, the concern would be that the demand for safe asset for public debt is still there because there is no very good alternative, and we see that in the numbers on investment, in particular in Europe, the lagging of the stock markets, etc. Or maybe that the rates of safe assets, which is now 4% in Europe, is very attractive. But what will happen when interest rates start to reduce if they bring down also long-term rates? We will see that those tensions coming up in terms of credit risk. So maybe this is an issue for discussion. The other related to monetary policy is this thing that I mentioned about the interdependencies. I mentioned that in the paper, in my chapter. We have got together, we have reacted very well to the pandemic in a coordinated way. Before the pandemic, before the inflation, it was time to disconnect monetary and fiscal policy, and then came inflation. And in spite of all that, things have been manageable so far. Okay, now there are starting to raise voices in central banking circles about fiscal policy restriction helping to reduce inflationary pressures. But the tensions by now are not that big. The question is whether when interest rates go down, drag down the long-term rates, then things may turn a bit more difficult for the interconnection between central bank policies and government policies. Those are the points I could make now.
Thank you very much, Kike, for these very, very rich comments and some questions. So, Vitor, you were addressed directly. Maybe you want to react immediately.
Absolutely. So a few points. One, I want to emphasize that price stability is very important for the management of public debt. In a sense, I take from Ricardo Reis the idea that price stability is the treasurer's best friend. If you think about a bond that happens to be regarded as safe by market participants, you have that the bond is a promise of a stream of cash flows over time, okay? Nominal cash flows over time. So the value of those nominal cash flows depends crucially on whether the price level is predictable or not. If you have high and volatile inflation, the attractiveness of that asset is reduced, and that leads Ricardo to argue that if one wants to be able to finance high levels of public debt in a way which is compatible with financial stability, it's very important to live in a credible environment of price stability. If not, as we have seen during the great inflation, you will have disturbances in bond markets, you will have bond market scares. And that is not an environment where a treasurer wants to be forced to operate. That's a very important point. Now, on your point, Kike, about monetary and fiscal interactions, there's an additional dimension of the interaction which is very important and that we stress in the trilemma. If you have a situation where public spending pressures are accommodated while revenues don't increase, you have increasing deficits, rising debts, and eventually you will have problems of debt sustainability and financial stability. Now, financial stability is crucial for the conduct of monetary policy. So that interaction between fiscal and monetary via financial stability is something that I believe we should emphasize, and I try to do that with the policy trilemma. Ugo, we are, I would say, brothers and friends. We are very much doing research along the lines that you have presented. The fiscal monitor in the fall will be dedicated to public debt and risks associated with public debt forecasts. We have a paper that basically does the same exercise that you have conducted in terms of looking at public debt episodes. We focus on the right-hand side of the distribution, so public debt explosions, what you called public debt explosions. The only qualification that I would make is that we emphasize the role of the exchange rate more, and we have an explicit decomposition that takes into account forex denominated debt, and that's a big factor when you actually look at debt explosions. And I would regard very large stock flow adjustments to be associated with bad public debt management. And in all of what you've said, I think that you would recognize that good rules, good procedures, good institutions are crucial to rein in the type of pathologies that you have identified in your research. I stop here, Ernst.
Thank you very much, Vitor. Ugo, you were addressed directly, a brother of thinking and authorship. What are your replies and your reactions?
Well, I mean, of course, I agree on this. So I came to this unexplained part of that from the original SIN research agenda, which was exactly what Vitor said. So that's I understand. I sometimes I emphasize the other one because I don't want to talk about this too much. There are also other factors, but clearly the big jumps, the huge jumps, are always driven, almost always driven by foreign currency debt. So the inflation. So I had a discussion. My daughter just started university and is taking macro 101, and a few days ago she was studying the Phillips curve. And so she told me, oh, but this is great. So we can reduce unemployment by increasing inflation a little bit. And then you tell them, no, when you try to do it, it doesn't work anymore. And she said, what do you mean doesn't work anymore? So that's, and this is the same thing, right? So if you have credible central banks, and if you have some unexpected spike in inflation, credibility helps you a lot and it reduces debt. But in the moment you try to exploit this, it goes away, right? So it's clear that, so either you go, of course, if you go to an environment of hyperinflation, then for a while, whatever domestic currency that you have, you can liquidate it. You still have a problem. So if you look at Lebanon, you know what it has happened, that the domestic currency debt has been liquidated, the other is still there. But yeah, so inflation can help you, but it cannot be the solution. So if you have some unexpected bout of inflation and you have credibility before, so you have enough long-term debt, it's going to help you a little bit, but that's not the strategy you can count on. And that's, in a sense, that's why I said, all this debt reduction via inflation are not a great thing. I stop here.
Thank you very much, Ugo. Now, we have some questions from the chat. Let me start with one from a certain Hassan to everybody. He wants to ask about the monetary and fiscal interactions in EMU. How does fiscal sustainability considerations affect the ECB's ability to control inflation? What would happen if at some point in the future the ECB indeed has to trigger the TPI due to some fiscal pressures in some EMU country? What implications would this posed to the ECB's monetary policy. Now, this is a question relating to fiscal dominance. So what are views around the table? Enrique, you mentioned the TPI explicitly.
Yeah, well, regarding the first, I mean, we have had that situation in the past, not related to a situation in which inflation was high. I mean, the capacity of the ECB not to control inflation, but to manage monetary policy during the fiscal crisis of 2012-14, monetary policy was hampered by the fragmentation of the financial markets due to the credit risk. And this actually was the justification, one of the justifications to start the asset purchases program, because a fragmented European Euro area zone, capital market area zone, that's what allow monetary policy to operate properly. So obviously the debt sustainability may impact on monetary policy through that channel. And if we change indirectly, and if we change the situation from an environment of low or even too low inflation as we had in that period of the past fiscal crisis to a period in which we have higher inflation, that may become obviously a big issue. Actually, the TPI was also justified in terms of avoiding fragmentation. And as a matter of fact, maybe I should use here a disclaimer. I'm not talking on behalf of the Banco de España or the Eurosystem. The justification is fair, and it's a degree of freedom to act if necessary. But I guess because of what you are seeing, that the TPI, the strong characteristics is that it's a signaling of the decision of the ECB to act if necessary. If it's tested, we don't know how it will work. That's
if I may, Ernst?
Yes, please.
So one thing that's very important to understand is that in the economic constitution of the monetary union, the guarantees of central bank independence are very strong. And in the context of Europe, the case for fiscal dominance is particularly implausible because fiscal policy is fragmented while monetary policy is single. Moreover, the link between monetary policy and fiscal policy is constrained by very clear prohibitions to, for example, monetary financing. TPI is one instrument in the toolkit of the central bank to guarantee the transmission mechanism, and it is a tool to be used based on monetary policy considerations. The ECB has built in a number of safeguards that prevent fiscal dominance to be a plausible consideration in the context of a possible future use of the TPI. So from that viewpoint, I do think that Europe is one of the least plausible environments for fiscal dominance around the world.
Thank you very much. Now, I think it was you, Vitor, who mentioned the topic of elections. Fiscal consolidation during elections, fiscal sustainability during elections. Now, in Europe, we are having super election year. And also in my own country, we are going to have elections. And, the topic of populism, of political polarization, are big themes here. And it is really hard to see how to square this with spending discipline. Political business cycles come to mind, political economy considerations. What would politicians need to do what would economists have to advise politicians in order not to fall into populist temptations of overspending in unproductive ways?
So, Ernst, I really thank you for that question. I think that you're spot on when you emphasize the importance of politics in fiscal policy, right? So, fiscal policy is always and everywhere political. And that is one of the reasons why we put out a book that I'm very proud of. We put it out in 2017, and it's not called Fiscal Policy. It's called Fiscal Politics. And the political aspects of fiscal policy are very well, at least from our perspective, reviewed, surveyed in that one book. In the Fiscal Monitor right now, we show empirical evidence that you do have a tendency, you have a propensity for fiscal slippages in election years. That can be measured in terms of average deviations of fiscal outturns in election years relative to normal years, or deviations from budgeted numbers. The orders of magnitudes are between 0.3 and 0.4 percentage points of GDP. As you, of course, know, Ernst, one of the justifications for fiscal rules, institutions, frameworks, is to try to insulate the conduct of fiscal policy from the electoral political cycle, which from a macroeconomic viewpoint is suboptimal and wasteful. And indeed, one does that by being transparent and accountable, and by having rules and procedures that constrain the incumbent government under electoral circumstances. Now, you cannot insulate fiscal policy from politics by nature, but you can have a situation where you have actually a political consensus that fiscal policy is in the political realm, conducted in accordance to some rules. And indeed, countries with stronger rules, institutions, and frameworks have a better performance in terms of their conduct of fiscal policy over the business cycle, but also in terms of protecting priority spending, like investment in human and physical capital. And you can read all about it in the Fiscal Monitor. I hope you will.
Thank you very much. We're very much looking forward to the fall Fiscal Monitor. Is it, yeah, the fall Fiscal Monitor? You really provide a lot of appetizers, so I'm really getting thrilled. Maybe we find an opportunity to also, sort of disseminate your consideration from there in a SUERF seminar in the future. So I have a question here from Martin Lark, who's actually, who stands for the European Fiscal Board. Niels couldn't join us, so at least we have a question from Martin. Could the speakers give their appreciation of the economic costs of alternative ways to reduce debt? Consolidation, restructuring, inflation is the reason why we see very few restructuring episodes in advanced countries, the risk of banking sector meltdown. And if I may add to this question, a specific question to Ugo, what about debt restructuring, debt relief for emerging, actually for low-income countries? To what extent do you see this come as a bigger wave, or is this currently not in the cards? So we have these questions both for advanced economies and for low-income countries. I don't know, maybe Enrique and Vitor, you want to start for the more advanced economies?
Happy to. So Martin is a friend and a co-author. So Martin, great to hear from you. Your question is precisely one of the themes that we will be covering in the fall Fiscal Monitor. We will be looking at how can debt levels be put under control and can actually be brought down in the best possible way in terms of the economic performance. There are no universal recipes to be offered, but in this fiscal monitor in the spring, we have an interesting example in the context of innovation policy. One of the findings in the fiscal monitor is that subsidies to fundamental research, in particular in large economies, have such important spillovers on the rest of the economy and on private investment that multipliers tend to be high. And it's one of the few examples that we have been able to identify where fiscal support actually pays for itself. That is a subsidy to fundamental research leads to crowd in of a private investment and private R&D spending that leads to an increase in GDP that is so large that the endogenous increase in revenues is more than enough to pay for this support. This type of thing is quite rare in terms of policies that we can recommend. But it emphasizes that if you're able to follow fiscal structural policies that promote sustainable growth and you get higher trend growth, that makes the adjustment down of high public debt levels much easier to digest on the part of the economy. Fiscal policy is also structural policy, and from that viewpoint, it's perfectly plausible that it promotes growth, although estimating ex ante magnitudes is hard because those estimates are very uncertain, as you well know, Martin.
Enrique, do you want to follow up on this? Do you have anything to add on that? I don't hear you. You need to unmute yourself. Sorry.
Sorry, maybe no, but I just want to make a remark. You have to choose the least bad. And the least bad is consolidation. And I say it's the least bad when we usually think it's a good thing to consolidate because it may kick off growth. Because of something I've said, and said it was a very important point, the ever-increasing demands on fiscal policy. It's going to be very difficult to set up a path of consolidation which is consistent with those demands in the current political situation. That's my point. So you have a complicated perspective going forward.
I agree, Enrique, but if you would ask me to give an example of the spending that I would cut as an economist, I would be cutting wasteful energy subsidies, in particular when we're actually subsidizing the use of fossil fuels.
Agree, absolutely.
Do you want to add something on this question regarding low-income countries, for instance?
So maybe let me say something about emerging market countries and developing countries. So the first point that I would like to make is that debt restructuring should always be the last resort. It's not, So I think on this I'm fairly conventional. I think of it like pulling a tooth. There are first you should try to do everything you can do not to pull it. And then at some point, maybe you need to pull it. And when you decide that you need to pull it, you should do it as fast as possible and in the best possible way. Now, where my views differ a little bit, now I think that the world has converged a little bit more towards my view, but still there are different views, is on whether we should be making this tooth pulling exercise as painless as possible. So the old story would go that the only thing that generates willingness to pay is the fact that defaults are extremely costly. So doing anything that make default less costly will be bad ex ante. So let me give you an anecdote that touched my life. So in 2006, I wrote with a colleague. I was working in a policy organization, and I wrote with a colleague saying, you know, this policy approach might be a bad idea because usually we don't know. Normally, we don't see policymakers that run to default. They actually policymakers try to do everything to avoid default. Might be even beyond the point in which default would be optimal. I was called together with a colleague who wrote this paper with me to the office of the vice president of this particular institution, and the person wanted to fire us. And then our boss defended us. So anyway, it was an interesting story. I can tell you once we have a beer. So this was 2006. In 2013, the fund wrote in a policy paper, which was authored by Reza Bakir, but not signed. It was a policy paper of the fund, saying, you know, defaults sometimes happen too late and too little, which is pretty much what we had written, you know, 7 years before, in a much more blended way in which they wanted to fire us. So my bottom line is that default and debt restructuring should be the last option, should be done only when there is nothing else that can be done. So they should not be taken lightly. But once we decide that a restructuring is necessary, there are many things that don't work in the current system of debt restructuring. And I think that things could be improved. And I don't think that improving things would have unintended ex ante cost, because there are many reasons why politicians don't want to default. You know, we did some research showing that politicians lose their job after they default, that clearly they don't want to lose their job, and many other reasons. So yeah, so that's what I have to say. It's when I listed as bad, you know, the stock flow, you saw that among debt reduction. So debt explosion linked to stock flow are mostly driven by balance sheet problems. It's foreign currency debt when the exchange rate depreciates. Most of the stock flow debt reduction are actually defaults, and these are not good things, right? So there are better ways, ideally, to reduce the debt, but sometimes there is no other way to do it, and in the moment there is no other way to do it, well, it would be good to do it in the best possible way, in the way that reduces the cost associated with a policy, which is incredibly painful.
If I may, Ernst,
Yes.
very quickly, I think that there is not much between my view and Hugo's. I would basically put it the following way. If debt is unsustainable, debt resolution should follow orderly, quickly, and expeditiously.
You said it much better than me.
Shorter.
Shorter.
Shorter, but the question is whether the related negotiations can happen so fast to ensure your demands.
Ernst, is our job as IMF in collaboration with the World Bank to try to promote a expeditious and speedy process. We have been working in the context of the common framework that is not delivering, in our view, fast enough. The Global Debt Roundtable is another forum that now promises a more timely resolution of these problems. It's work in progress. It's work in progress, Ernst.
Yeah. Thank you very much. Now, Hugo just mentioned stock flow adjustments in emerging markets as a major driving force for debt ratios. I have actually two questions here which are somehow linked to stock flow adjustments. The first one is by Markus Eller from the JVI, Joint Vienna Institute, which of course Vitor knows well. A question, given the important role of stock flow adjustments for debt explosions, could you please provide a bit more background on the drivers of stock flows across countries? Is it becoming mainly from exchange rate depreciations combined with a high share of FX-denominated government debt, something we often observe in emerging market and developing countries? And the other question is by Johannes Holler from the Austrian Fiscal Council. And my colleague Johannes asks, substantial parts of stock flow adjustments are due to emissions taps of debt above or below par values. Since bond yields are strongly linked to real interest rates, growth rates, and inflation, stock flow adjustments are also linked to these variables. Separating the drivers of debt explosion without considering the endogenous reaction of stock flow adjustments appears to underestimate the importance of economic growth rates and inflation. Do you expect this ignored endogeneity to be of quantitative importance? This links a little bit to one of the answers that Vitor gave before on the importance of growth. So maybe Ugo and Vitor, you want to react to these two questions?
So from a quantitative point of view, and as Vitor said, and I think we'll get more evidence in October, I do think that balance sheet associated with a balance sheet effect associated with foreign currency debt are, at least for emerging market countries, the main drivers of this. But sometimes there are also large contingent liabilities that show up. So at some point, your colleagues, Bova and others, they had a paper in which they collected all these episodes. It's an incredibly painful work to collect this data because, from what I remember, they went through all the possible Article 4 and everything. And so the data set is a bit outdated now. I think it goes to 2014 or something like that. But there are also cases in which you have debt explosions which are associated to, you know, a large state-owned company that goes bankrupt, a large state-owned banks that go bankrupt, or some sort of misdesigned public-private partnership project. But I would say that from a quantitative point of view, the balance sheet effects are still the main drivers, so are the main things of the bad motorcycle, if you want to go back with the old analogy. I don't think that the second factor, the valuation effects linked to movement in interest rate, play an important role. Also because most of these exercises that we do are done using the face value of the debt and not the market value of the debt. And so these things clearly affect the market value, but don't affect the face value, which is another issue that we have to think about. You know, when we do these exercises, we always think in terms of face value and not market value. Whether this is the right thing to do or not the right thing to do is not clear. But
so, if I may add, on your last point, Ugo, Tom Sargent would argue that we as economists should mark to market, right? And when he analyzes fiscal policy in the US or in other countries, he always does that, and he corrects the series of public debt so that he actually has the indicator that would be on the balance sheet of the public sector if the accounts were structured like corporate accounts. That's what Tom does. In a sense, at this point in time, we are not in a position to do that for public sector accounts. But one aspect that the IMF has been promoting is the use of a public sector balance sheet approach that considers assets and liabilities at the same time with an approach to accounting, which is accrual accounting. And that will allow a much more controlled way of looking at risks associated with assets and liabilities in the public sector balance sheet. I do think roughly the decomposition exercise that I believe I remember, I'm quoting from memory, so I may be wrong, is that valuation effects associated with forex denomination of debt is about half of the stock flow adjustment. So it's by far the largest single item, but the remaining is quite big. It's kind of about aggregate, it's about the same magnitude of forex. So there is a lot of action that has to do with other factors. In 2014, the IMF published a fiscal transparency evaluation for my country, Portugal, and it decomposed the public debt path, looking at drivers of the public debt, like the primary deficit, as you've done, but with tremendous and very disaggregated documentation of the sources of shocks to public debt that you would label residual or stock flow adjustment, Hugo. And for our Austrian friends, I think that one possible case that they may find enlightening is this fiscal transparency evaluation for Portugal. It's not the only example of IMF work in this direction. There are many other fiscal transparency evaluations. I happen to know this one particularly well.
Thank you very much, Vitor. I would have a number of further questions, but we are running out of time, so I'm afraid I cannot ask them. I think we could have discussed quite a while about the role of a central fiscal capacity in the EU. Kike touched upon this, and I didn't have the opportunity to ask the others' views on this. And I think another topic which I would have loved to discuss, but which we cannot delve into now, is the scope of increases in efficiency and better targeting of fiscal policies using, modern technology, digitalization, big data, and AI. I think governments have a lot of scope for improvement there as well. And I think this will be worth discussing in future events. Now, this brings me to the end of this SUERF BAFFI Bocconi webinar on fiscal policy in a turbulent era. A great thank you to Enrique, Vitor, and Hugo for your excellent presentations and the vivid discussion. Thanks to all of you for your interest and for your very interesting and well-informed questions and comments. I hope to see you soon again at a forthcoming webinar or conference. Bye-bye and take care. Thank you so much.
Thank you.
Thank you. Bye.
Bye.
Thank you.